Hello everyone and welcome to the Week in Markets. I'm delighted to be joined by my co-portfolio manager, George Bell. So George, a lot going on within asset market movements since the start of the month. Do you want to bring that to life for viewers?
Yeah, absolutely. Strength has been there in global equity markets, mainly if you're a sterling investor, and the strength in equities has really come from what's actually a pretty robust economic growth picture. We've seen a number of data prints which we'll come on to from the US, which is demonstrating real resilience. So this has been positive for the US market, but we've also seen this in Europe, we've seen it in the UK and in Japan as well. I mentioned returns have been boosted by sterling. That's essentially because we've seen such strength in the dollar. So if we look at sterling since the start of the year, it's actually down about 1.2% relative to the dollar. So that translation effect has actually been quite supportive. And it's actually helped offset one of the bigger headwinds that we've seen in markets since the start of the year. And that's been bond yields, which have been moving higher. We've seen it in the US, but more so in the UK. So for context, if you have a 10-year government bond in the US, you've seen the yield on that bond move up around 11 basis points, so around 0.1% to a level of 4.7% now. And in the UK, it's been an even bigger move, Chris. It's moved around 0.2% higher. So the yield on a 10-year gilt at the moment is around 4.8%. So that's quite a material increase in terms of the borrowing costs. And that's led to some volatility in the equity market, and it's led to some drawdown, which we've seen within the fixed income market. Partly because of the strength of growth, which we're seeing, partly because of inflation concerns, partly because of the fiscal spending plans that we're seeing from the US in terms of tax cuts, what that means for government deficits, and in the UK as well, government spending and increased supply of bonds in order to finance that. So it's actually put Rachel Reeves in the budget, which we had announced at the back end of last year, in quite a tricky place actually, because although it's not as drastic as previous budgets which we've seen, it's coming at a higher cost of borrowing, and that's what the market's really struggled to digest. So probably the majority of the volatility we've seen is actually in the bond market coming into this year.
Yeah. Excellent. No, thanks, George. And just maybe from myself, just a little bit around some of the kind of key economic reports that you mentioned there. So you talked a little bit about the US economy being very strong. Probably the key things for me this week were two things. So the Fed minutes and also the JOLTS data. So maybe starting with the Fed minutes, what did we see there? So originally, you might remember going back to December, there were 4 rate cuts, so 4.25% rate cuts within the Federal Reserve, so the US Central Bank's projections. What happened in December is they released new projections, and then the 4 rate cuts actually became 2 rate cuts. So basically a signal that interest rates will remain slightly higher for longer than what was originally projected overall. And then within that, also what we saw within the Fed projections was just a likelihood of more volatile inflation, maybe slightly higher inflation as well. Now, what we saw this week was the minutes from that meeting come out. So this is a really big thing for investors. So investors will kind of pore through the minutes, looking for how different words have changed to try and, I guess, gain some sort of clue around actually the direction of what is the Fed thinking in respect of interest rates. There was a great quote that Jerome Powell came up with, which is all around the uncertainty right now, and that uncertainty is led by Trump's policies, so the immigration policy, but particularly the tariffs. But the quote he came up with is, it's a bit like walking into a dark room full of furniture or driving on a foggy night. So you slow down. So what does that mean? It means that the Fed are being quite cautious around rate cuts overall. And to me, that's quite understandable. They're trying to understand what is the current environment, how will that environment be affected by Trump's potential new policies overall.
So it feels like the market have really taken the narrative which is coming from Powell, the revised expectations in terms of growth and inflation, and actually walked back the number of interest rate cuts that they expect to see. So that's in part the reason we've seen bond yields move back higher.
Absolutely, yeah. And I think, it was interesting. I was looking at sort of how equity markets and how bond markets moved on the back of the minutes.
Mm-hmm.
Actually, equity markets were pretty positive.
Yeah.
So for me, it was a signal that actually, a lot of what was discussed in December was already really just priced into to equity markets overall.
So it feels like coming into this year, the market's a little bit more focused on fiscal policy, so government spending and taxation policy rather than monetary policy, which has been in focus for much over the last 2 years. And we can really see that in terms of the way in which the bond market's moving. It's really the longer maturity bonds which are more sensitive to inflation and growth dynamics than interest rate policy dynamics, which is where we've seen the biggest move. But a lot of this is coming off what we've seen in terms of the jobs data. Was there any updates through the course of this week?
Yeah, absolutely. So we received the JOLTS data, so the Job Openings and Labour Turnover Survey data.
Another acronym.
There you go, yeah. So basically this looks at job openings in the US economy. So they came in at 8.1 million. So that was above expectations. And if we compare that to October, it was ahead of October. So October was 7.8 million. I think the one thing I would say is that the gap between demand and supply is cooling, but it's actually coming from a very high base overall. One thing that I did pick up, just sort of reading through the note that comes with that, is just really around the quits rate. And that quits rate has slightly reduced. And so what you're seeing there is just maybe at the margin, people are less willing to quit their jobs. And that could be because actually it's maybe a little bit harder to go to another position. I think one thing that is important, though, is that the job environment is still very supportive. I mean, if you look at the unemployment rate in the US, that's coming in at 4.2%. So again, compared to longer term history, that's really favourable.
And on the strength of that, if we look at interest rate expectations, you mentioned earlier, September expected 0.25% interest rate cuts or whole percent of interest rate cuts to come through this year. That's been pulled all the way back to between 1 and 2 now, just looking on the screens before we came down. And actually, if we look for January, there's only a 7% chance that they're going to cut in January according to market expectations. So that strength of labour markets, which has kept inflation quite persistent, given we're seeing further readings of this, the market's basically saying we're not expecting to see a rate cut in January.
Again, it makes sense, though, if you think about it. You've got a really strong economy. You've got really low unemployment. It's not like you're in a situation where the Federal Reserve are thinking, oh, no, we need to cut rates really aggressively here. Therefore, I think for me personally, I can understand why the Fed are pausing, trying to understand exactly what's happening within the overall environment.
Yeah, absolutely. And interest rates, they operate with a lag, typically 12 to 18 month lag before they have an effect. So they do need to take stock of how inflation dynamics and growth dynamics are evolving. And if we look at the UK, currently expecting 2 interest rate cuts for this year. And if we look in Europe, you're seeing weaker growth dynamics in Europe across France, Germany. And because of this, they're expecting to make 0.25% interest rate cuts through the course of this year. So actually, you've seen once more, after we saw a bit of recoupling in terms of the trajectory of interest rate across developed markets, it started to diverge a little bit between US and UK and what we're seeing in Europe now.
Excellent. Well, thank you, George. That really was a kind of whistle-stop tour around everything to do with asset markets, the economic data that we've been seeing, interest rates, inflation. I hope you all really enjoyed today's Week in Markets. And George and myself look forward to speaking to you soon. Thank you.
Thank you.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value and you may get back less than you invest.